Good morning, everyone. Thank you for joining us for today's webinar. A little bit of introduction about myself and the firm before I jump into the material. So I'm Trevor Kennedy. I'm the managing partner at Logan Katz. Logan Katz is a full-service accounting firm. We cover companies really, in my tech world, I like to say we cover them from seed all the way to sale. The only activity we do not do is audit public companies. So we can handle our clients all the way up to the point if they want to go public. At that point, we make a nice handover to one of the large national firms. And in my role, I've developed an expertise in dealing with all things technology related, startups, whether you're pre-revenue, you're in your raising function, all the way growing to mature clients and then either acquiring or making exits. So today I'm going to be talking about shareholders agreements and stock options in view of the technology world, and specifically in that startup realm. And these are two very important documents that that you will need to have done and have done correctly at the very beginning. As we'll go through, I'll touch on some do's and don'ts, and then the next of the focus will be pushed to stock options and the implementation of a stock option plan. I expect this should run about 40 minutes, and then we'll have a Q&A section or session at the end. So a brief overview of what we're going to be covering. Again, I'll focus initially on on shareholders agreements. Again, focusing in that really early stage and what you should have in place, and then we'll switch gears and work through the stock options issues and rules. So what is a shareholders agreement? When I'm dealing with people who are thinking of getting into business, this is the area where we put a lot of focus. It is an extremely important document. It is really going to lay out all of the potential dispute resolution issues that you may or may not come across in your whole life as a company, that is. And what's important is this document needs to be done at the same time as the incorporation process or the onboarding of new shareholders. Once you have shareholders who are ownership in the company, they do not have to sign a new shareholder agreement that's going to be implemented. So this is the importance. It needs to be done right at the beginning before people become shareholders. Once you're a shareholder, you don't need to sign a newly created agreement if you don't agree to the terms. So this has to be done right away. And when they're not in place, the downside is, and the unfortunate reality, one of the problems that I wouldn't say it's a common problem, but it's not uncommon, that we're dealing with a group of founders who just got started, were very excited with their business opportunity, and then a year or 2 years later, we're working with them on some of the compliance end, and one of the problems we're coming across is that one of the original founders has since left the team. And if they left the team and there's no shareholders agreement to address that exit, they still own usually a healthy percentage of the company. And there's nothing that the existing shareholders can do unless you can come to an agreement with that exiting shareholder of how much you want to buy the shares back for. And again, in that startup world, that's a common problem where everyone's perceived value is much higher. And so you have these wandering shareholders, people who are owners in your company who are no longer associated with the company. Specifically, if it's a founder with a significant piece, this can cause a lot of friction. And also they're going to be getting the benefit of the growth of the company from that point forward, even though they're no longer contributing to it. So this is one of those reasons why you need it addressed initially. And what is the overall agreement? Well, this is an agreement outside of the incorporation process. And again, I recommend it's right at the beginning when you're thinking of getting into business. When you're in that phase of when you're starting the business, you want to identify sometimes in your founding group, one individual is going to have more say than the others. However, the ownership percentage for the benefit might be the same. So you can address these kinds of issues of who's going to have control of the business. Um, you can deal with what happens if the founding group, there's dispute. So this is a dispute resolution mechanism. Hopefully you never have to result back to what does the agreement say and how someone can exit the company. But ultimately, if nothing can be decided amongst the individuals, you can always fall back to what does the agreement say, and let's follow through. So you really want to think ahead. The nice issue when you're dealing with shareholders agreements in the startup world, you don't necessarily need to have a full-fledged 30-page document which covers effectively everything, but there are certain pieces you want to make sure that do get covered. And again, that's how are we getting into business? What are the efforts that are going to be put forth, right? I've dealt with some groups where some founders are working part-time, others are working full-time. And then how do you address these issues as far as sometimes it's dealing with remuneration, sometimes it's with the split on the ownership. Again, your agreement can help cultivate whatever it is the group wants to do. The nice thing when you're at this stage of starting the business, everything is typically going well, right? No one's really out any money. No one has put in significant amount of time at this point. So really it is that ideation stage. Everyone's on good terms. It's the perfect time to hammer out your agreement so that everyone can be fully aware of what they're agreeing to and getting into business with. While your company is in business, the next issue you're going to have to deal with is the onboarding of new shareholders, potentially. And again, this is another issue where you want the new shareholders to have access to your agreement, to agree to the agreement before they join the company. Same issue if you just started out already and there's two founders and you want to onboard either a third founder or a third significant shareholder, and you haven't got your agreement in place for the two of you, well, you should definitely, when you're bringing in a minority shareholder, you definitely want this agreement in place. I'm currently dealing with a situation right now where it was just that structure. There were two individuals, they were okay forgoing the agreement initially. Again, our recommendation was to have it in place. Nonetheless, they brought on a third minority shareholder. At that point, that's when they decided to get together, hammer out their agreement. So they got their shareholders agreement in place, were able to onboard the new person. Fast forward 2 years later, we're now in the issue going through the details of having that third person exit the business, and then how are they going to deal with a potential exit from the shareholdings. Again, we're defaulting back to those clauses of what did everyone agree on at the beginning of how someone is going to successfully exit the business in an amicable fashion. Some of the other things you might want to consider if someone's going to have a substantial change in effort. I've also been dealing with a couple of startups where, again, initially the intent is everyone's diving in, going 110%. You fast forward a year or two later, and then someone's personal life is changing and they're dialing back their ongoing efforts. So now it's someone still going full bore, but you have someone else working at a more of a part-time pace. And you can envision at the conception of your business, what's going to happen if these changes are going to occur and how are we going to deal with them? And in the existing case, we're sort of looking at as the efforts are changing, more of the ongoing control is going to default to the person going full steam, but they are still in an agreement on their overall income and equity split. But it's really just an idea that it's more of a short-term change in effort. If it goes on for a prolonged period, they're going to have more detailed sort of discussion and what that change could result in. But the nice thing is these shareholders agreements, they're very, very powerful legal documents, and they are outside of the ownership. So you can really craft them in any which way you want and address all sorts of different needs. So in the startup world, what exactly are the items that you're going to be coming across that really do need to be hammered out? I always focus the first thing you want to do, what happens if someone's going to leave your business? How are we able to protect the company and the existing shareholders if someone is going to be exiting? One of the things we like to do is have a reverse vesting schedule in place, which means that the longer the founders are with the business, the more higher percentage of their ownership gets locked in. So for example, if you start out with 4 individuals, 25% apiece, someone decides to leave after 6 months, depending on what reverse vesting schedule you have, the company will be able to claw back the majority of that exiting shareholders' shares, so that the person leaving within 6 months may or may not have any shares at the end. Again, it's all agreement on what kind of schedule you want. So I personally, I do recommend having a cliff at some point. Maybe it's a year, 18 months, and then every quarter, more and more percent gets locked in. So again, the theory is the longer that your founders are with you, if they do have an exit, they do walk away with something because they have contributed to your business. But in the absence of having anything, this could cause someone leaving, in my example, and owning 25% of the business. Again, they will get diluted as you do future raises, implement stock options, but it'll still be a very significant piece of your business, and they'll no longer be contributing to the future growth. So that sort of goes along with the potential buyback provision, right? If someone's going to exit, are there going to be any buyback provisions based on fair value, based on what was initially contributed? So you can address not only that vesting schedule, but how is the buyback going to work? And again, it's nice at the beginning, everyone is on board, everyone's in a good mindset. It's a collective agreement so that you have the ability in a year, 6 months, whatever time frame, in the unfortunate event, if this is going to happen, everyone is aware of what they're going to be receiving as a result of their decisions. We very strongly recommend having restrictions on transfers or individual sales of the shares. When I think you're in that private company world, you really do want to restrict one's ability to make a sale of their own ownership. So you don't want other shareholders coming in that the group isn't agreeing to. So you can really restrict the individual. They won't be able to sell their shares. They won't be able to transfer them, subject to a large exit. And then a drag along clause is another, again, you definitely need this, especially in the world if you're going to have minority shareholders, like stock options, for example, where there's certain transactions where you need all the shareholders to sign off from a corporate law point of view. So a drag along clause, this will allow, if the controlling individual or individuals have the opportunity for an exit, you cannot have a small minority shareholder holding up a potential sale because they're disagreeing. So effectively, all your minority shareholders are going to be agreeing to what the controlling group wants to do as far as an exit and in terms of the sale. So again, it facilitates the ability for that founding group really to act on a sale without having to worry to get the approval of your minority shareholders. As I mentioned, when you get to the point in the operating world, we were dealing with, let's say, a family mom and pop, whether it's a consulting company or a coffee shop or a bakery. Typically speaking, these shareholders agreements are very thick, lots of details put in place. In the startup world, sometimes your money is best spent. There are certain pieces you want to get closed off initially, and then you can work on getting a more full-fledged agreement down the road, especially when you're going to be onboarding VCs. They'll probably rewrite your agreements for you anyways. There are certain things that get in place up front, which is why it's important to have those discussions with the lawyers and cross off really the important pieces that you need to have in place to allow you to start your business and start growing. So going hand in hand with the shareholders agreements, and I talked about having minority shareholders, is the implementation of stock options. And I guess when people hear stock options, it's important to realize that this is not it's not an option or viable option for every business, right? You really want to think, what is the purpose of having stock options? And if you're in we'll say a lifestyle business that you're not looking to grow and have a potential exit, it's just, again, a very lucrative business. You're enjoying your life. You're making a lot of money. We have you set up with the family trust and the holding company. And if you're not really thinking of an exit, then you have to realize, why would you implement a stock option in the world if there's not going to be that accelerated growth with large exit? You could, in theory, without stock options, if you're looking to remunerate your employees extra, you could just give them bonuses as opposed to giving them stock. Right? If you're not going to make them an ownership in your company, but you want to reward them on a yearly basis, you could just increase either their salary or give them actual bonus in cash. However, if you're in that growth world, or you're looking in a business where having an exit is the long-term plan of where you're working to, all of a sudden, stock options are a viable option. And that's because the option it'll incentivize the employees to take an ownership approach to your business. And they're still going to be making their salary, but what it does, it gives them the long-term view that the more they contribute to the company, the better the company is, or the higher the value, and the sooner the exit. And then that's when the employees are going to monetize for their efforts, right? So if there's no exit, the individual with the options doesn't get any benefit. So it's really, you have to align, what is the business purpose? What is the growth strategy? What is the exit strategy? And if these pieces all align in the world of implementing a stock option plan, they can be quite great, especially when we're dealing in today's reality where cash might be a bit tight. We do recognize we want to reward our employees for the efforts that they've been putting in. So if we can give them compensation as opposed to giving them cash, i.e. a bonus, or maybe even a reduced salary, and then top them up with options and ownership in the business. I do have a point at the bottom of the slide here, and it's a very important one. And again, in my tech world, I see this a lot. CRA has very favorable stock option taxation rules in the CCPC, the Canadian Controlled Private Corporation realm. However, I often see companies looking to give options to their advisors, or sometimes their contractors. To get into the stock option rules for CRA, the individual must be receiving the option due to employment, which means if we're looking at contractors or advisors, anytime you're making a payment, whether it's in cash or shares, it's a value for service issue, which creates taxation, not at the company level, but at the contractor or advisor level. In theory, they will be receiving some form of compensation, which is really a value for service. So there's going to be tax in their hands. Depending on their individual structure and the dollar value, anytime a contractor is doing work, it's considered a taxable supply. So you have the HST applicability. So again, contractors, which equals value for service, equals taxation, which equals HST applicable, which is why we have the bad news bears. It's just being aware that when you're going to be giving value to people who are not employees, they do not fall under the very favorable stock option rules from CRA, which is meant to reward employees. So they need to be receiving these options as a form of employment. And then additionally, I mentioned it, and we'll sort of cover the reality when you're dealing with a Canadian controlled private corporation versus a non-CCPC, so think a public company, there are very different realities in why a stock option plan would be implemented. So I'll cover quickly what happens in the non-CCPC world. And this is really, stock options are just another way of increasing individuals' compensation. So it's not so much worrying about having that potential exit. Again, these are public companies. It's more of just getting additional compensation into the employee's hand. CRA does recognize this, and there really is, when we're dealing with offering options at a discounted price, so the incentive for individuals to buy, there is no tax deferral opportunity, right? The discount from the exercise price versus the fair market value at the date of exercise, that is going to create employment income. And this is when the options are exercised. So what happens, again, is just a way of simply topping up an individual's salary. Typically, again, we've seen on our personal tax practice, again, as I mentioned, we don't do audits for public companies, but we do see this on the personal tax side. When individuals receive RSUs or restricted stock units, it's a very similar example to stock options, same rules. And then what we've seen with Shopify specifically, they'll issue an individual X amount of RSUs because there's employment income, right? Anytime there's the discount between what the exercise price is and the fair value. So in theory, if someone exercises their options and then sells them, they're going to have a gain right away. Well, that gain is considered employment income. So what Shopify has the ability to do is they'll issue a large amount of RSUs. They will automatically sell enough of the shares so that the cash proceeds from those sales will cover the taxes to the individual. And this actually leaves those individuals with a smaller amount of shares, but they have a high adjusted cost base. And the taxation on this, again, it gets covered on the individual's T4. So the employee is not going to owe significant amount of taxes from this transaction because the company, in this example, Shopify, has already liquidated the shares to cover the taxation. So they do walk away with a smaller amount of shares, but a high ACB, which means when the individual sells those shares either immediately or in the future, you'll get to take advantage of the high ACB. Coming back to the world that we live in and that we advise in is back to Canadian-controlled private corporations. I've already started taking that concept, thinking the family bakery versus a mature tech client who may or may not be exiting versus the startup world. In CCPC, there is no market for shares. So why would you issue your shares unless, of course, you're looking to have that exit? So this is coming back. What is the business purpose of of the company, and why are you implementing a stock option plan? So it has to all be about, is there going to be a potential exit? And if so, can we get the employees to benefit from that future exit? It's also very common, those early employees that you're hiring, they will have a repressed salary, right? The cash is not the same at the very beginning. Again, you'll find the employees who typically work for the startups, they have that mind. They really do like the pressure and being part of that growth team. So having stock options is a way of rewarding those early employees for their efforts, knowing that they weren't making market salaries at the beginning. It will actually tie employees to the long-term success of the company. When someone has ownership in something, even if it's a very small piece, again, if the goal is that acceleration, you want to sell your company for 20, 40, $100 million, having a very small piece of a very large exit is very encouraging. It'll keep people with the business longer. You'll be able to get extra effort out of them because they know that they're working towards the growth. In the startup world, there's many different life cycles, and stock options they do come into play really at all phases throughout that life cycle, right? Whether you're at the stage of you're trying to attract an additional founder, if you're looking to get some seed financing, whether you're utilizing safes or convertible debt, all the way through to taking a series raise. At any point, whether you're attracting founders, obtaining seed financing, or you're into the series financing, stock options will come into play. There's a different reality at each of them because the purpose changes slightly, and also the fact that if people have put money into your business, for example, in that very early stage, when you haven't raised money, if you want to reward your employees, the only people that you will be diluting by implementing a stock option plan are the existing founders. So if the founders are okay with not receiving cash, we can utilize the plan so that the exercise price is extremely low. And I'll talk a bit about that in a few slides. When you sort of graduate and you've taken on some money, but it's in the form of a safe or a convertible debt, again, these individuals are not going to be diluted because they haven't actually bought shares yet. So same concept, we can get shares at low exercise prices down to the employees because no one's really put in money for shares, or your safes and convertible debt has not yet converted. Once you hit the series part, Now you have individuals who put in significant amount of money for a relatively healthy piece of your business. And I can tell you, if any one of you were to invest, we'll say $1 million into a company on a $5 million valuation, from that point forward, we're not going to allow someone to get shares in the company if they're not going to be contributing cash based on the valuation that you've paid, maybe with a slight discount. So we typically see once there's money invested in their shares that have been issued, all of a sudden issuing stock options are being issued with, and I do apologize, I think my dogs are barking behind me. So yeah, exactly, it's a different issue when someone is going to be formally diluted by having money come in. So a different reality, but they still have a very valuable function with the goal of getting ownership to that group. So how does the taxation of a stock option work in the CCPC world? We have the ability of a tax deferral opportunity. So bear with me, I'll walk it through. It's a little complicated. I have sort of the rules written down here, but if you look at the difference between the exercise price and the fair market value at the date the individual exercises the options, that will be employment income, same as in the non-CCPC world. However, in the CCPC world, that taxation only happens in the year that the individual sells their shares. Right, so now we have a form, you're going to calculate the difference. It is employment income, but there's no initial taxation. The taxation will happen in the year that the individual sells the shares. Again, CRA is taking that approach that these options are they're in a market where they can't readily sell their shares. If you think to receiving RSUs of Shopify or any public company, you can turn around and liquidate those at any point in time to get cash. If you have options of a startup, you don't have that ability. So CRA does recognize that, and the taxation happens in the year when you sell your shares. So that way, in the year the individual is receiving money, that's when the tax bill will come due. Further, if at the date that the options are granted, if the exercise price is equal to or greater than the fair market value at that point in time, the individual actually gets a 50% reduction of that employment income, thereby making any income inclusion to be treated as if it's a capital gain. If you grant the shares at a price less than fair market value, so if we make them worth a fraction of a penny per share, the employee is still going to be entitled to that 50% reduction as long as they've held the shares for 2 years before the sale. So all this to say, again, it's a lot of wording, but effectively, we can get the most beneficial tax treatment to our employees by making them pay the least amount of money as long as there's that 2-year holding period. It's very lucrative, or I shouldn't say lucrative, but it's a very beneficial taxation in the non-CCPC world. So this is just sort of walking through the difference between the exercise price and the exercise income tax deferral. So you can see what happens when the fair market value, when someone exercises their shares, that will be their ACV, their adjusted cost base of the shares. Anything that the individual receives upon exit will be a capital gain, right? So let's say the individual exercises their options, so now they own shares. There's a formal exit, we'll say in 2 or 3 years. The growth from the point of when they exercised, so not based on what they paid, but the fair value at that point and what they've received, that's their capital gain, possibly subject to the lifetime capital gain exemption. And then we now have to deal with the difference between that value at the date of exercise versus what they paid. And that's where you subject to that 2-year period to get the 50% reduction versus 100% inclusion. So I've talked about the upside of options. What happens if the company fails, right? Unfortunately, there's no way around the income inclusion. When someone is dealing with stock options, if they're exercising at a lower price than the fair market value, there is employment income. The fact that the company goes bankrupt or fails in the future doesn't negate the fact that the individual still will have taxation. However, you can see at my last point, it's usually nullified by the ability of the individual to claim what's known as an allowable business investment loss. Again, subject to, it won't apply to everyone, but as I go to the next slide, the way an allowable business investment loss works is 50% of your loss is a tax deduction. If you remember back a few slides, as long as you meet that holding period, 50% of your income inclusion is all your tax done. So if you have a 50% income inclusion and a 50% tax deduction, you actually walk away, there will be no taxation. The 2-year holding period becomes important. Again, in our experience, companies who are issuing stock options to their employees, they typically do not fail within a 2-year period. So you're almost always safe from this. However, you do need to talk to your professional advisor to make sure that if you're in this situation, are you going to be okay? There are some compliance issues when we're dealing with stock options, right? We have to consider the fair market value which has been identified. I mentioned earlier, there's employment income. So the onus is on the employer for the tracking and how this gets issued on the individual's T4 in the ultimate year of disposition. So not only when you do the stock option implementation, there are legal documents that need to be in place. You need to consider what do you want to do from a pricing point of view, but then going forward, you do have the requirement and the onus is on the employer to track these values and to make sure that the individuals are reporting the correct income. So how do you value the startup? In these early stages, again, if we think back to that life cycle where you are, usually just having amongst the founder group of that a business discussion on what is the company worth and documentation. Maybe it's at a quarterly shareholders meeting of the founders where you meet and I would just document it, keep some like a management document of the different dollar value tracking. It as you progress further and further to the point once you have your seed raise it, again, these processes get more evolved as your business evolves further, but having some documentation of at least having, we'll say that quarterly meeting where the group is agreeing this is what the value is. Again, that's who is CRA to say that you're not making your best attempt at evaluations. You need to do something. You can't just stick your heads in the sand and not worry about this because it potentially could come back to bite you by not doing the proper treatment from the beginning. It's lots of dates. The more employees you have involved in the option plan and the option pool, again, it creates additional work because you have different dollars and timings. So you really do need to have a good governance side to track all this information. And again, the T4 reporting that will be based on the taxation rules, typically is when the individual is disposing their shares. So if I think back to, again, we talked about what is the business purpose and why would someone implement stock options? I've talked a bit about the tax rules, and the nice thing from a CRA point of view, they're quote unquote stock options, so options obviously are included, but CRA also considers the granting of actual shares to fall under the stock option rules. So that means that if we come back to how are we going to price the exercise price, if we want to just simply bonus the shares out to our to the employees, we can fall into the stock option rules. Again, a couple of things need to fall in place, but generally speaking, issuing shares to your employees will be deemed to be stock options. However, shares need to be issued for a fair consideration or past service work. So if you have existing employees on hand, your past service at a reduced salary, you do meet that criteria. So you don't have to worry about getting shares into individuals' hands without them paying for anything. If we're going to be dealing with new hires, we can get options to someone for a fraction of a penny. So thinking there's no fair consideration because they're effectively not paying anything. There's no past service because they're new employees, but we could have similar to the founders, a reverse vesting clause where the employee is quote unquote earning the shares over time. So again, it's just, there's ways around what we can do. Get the shares into the employee's hands, again, subject to a reverse vesting clause. Coming back to the life cycle, if you're pre-money, if no one has put money in for stated shares or stated capital of your company, utilizing this method of getting shares in their hands and having a reverse vesting schedule works. No one is getting diluted. Anyone who's going to be putting money in is going to come in after the option plan is in place, which is going to dilute the employees, not the other way around. Once you've taken on someone's money, you no longer can, or I shouldn't say you can't, because technically you can, but the VCs and who's ever giving you the cash, they won't let you do this. They won't want you to issue shares for free to individuals. You can still implement a stock option plan, but generally now, coming back to the valuation, you can get the shares with a reduced pricing, but the employees are still going to have to pay something to get access to ownership in your business. And again, this also makes sense. The further along in your life cycle, once you've done your raise, there is value within the business, and you're no longer about trying to get shares to the people who helped you out initially for nothing. At this point, if your employees want to buy in for the future growth of the firm, that's great. We encourage it. We want them to pay some money. We want them to have skin in the game. Versus in the early stage, now it's just a matter of recognizing a few key people who have been there from day one and have helped us. We want to reward them by getting them shares. So again, it's thinking back to that, where are you in the life cycle of your world will dictate the pricing that you want to put in place for the stock options. And again, just to bring it full circle to when we compare the stock options with the shareholders agreement, it's really, we always want to consider a buyback provision, right? The hard reality is sometimes founders believe employees, generally you will be dealing with employees leaving. So one of the things you'll need to consider up front is, what do you want to happen if you have a key employee who had been with you, has bought into the stock option plans, and they now own shares in your business, and after a few years they decide to leave your business? Do you want that individual to still own shares in your business or not? So you need to consider all these items, which is great. That's why I'm working with professionals such as us at Logan Katz. There's a lot of lawyers who delve deep into the tech world, getting their thoughts on what you can do to protect yourself and the business. Get all this hammered out with agreements. It's important to have the agreements in place right at the very beginning. And then just reinforcing, when we're dealing with founders, it is always, I'm a very strong proponent of having some form of a reverse vesting. Again, we're just trying to protect the business, knowing everyone's intentions at the beginning are always great, right? Whenever, we're not saying that no one has bad intentions. Everyone's intention is truly strong. We want the business to succeed. The hard reality is that not everyone is going to stay with the business, and you want your agreements in place and everyone agreeing to those terms to protect the best of the business. What do we want to happen if someone's going to walk away after 2 years? It's not the same answer for every business. Some people will be comfortable with someone putting in 2 years and maintaining that significant percentage. Others will want a smaller amount, but that's up to the group to decide, so that when the event happens, it's no longer a bigger discussion. It's more or less, what did we agree upon at the very beginning? You can always agree to something outside of that, right? This is just your agreement is the default. If you cannot come to an agreement amongst individuals, let's default back to what we have in writing and what we all signed. So with that, that's the end of the presentation. So thank you for sticking with me for, I said it's just about 45 minutes. I do appreciate it. I will be available for the next 14 minutes for some questions. So Stacy will help moderate if there's been any questions throughout the process.
So it doesn't look like there's any questions at this time. If anybody has any questions, feel free to use the Q&A function at the bottom of the screen. So we do have one question now. It says, volunteers can reward them with shares, question mark?
You can, all right? It's I look at volunteers more along the lines of the advisors, because typically your advisors aren't getting paid. So you could, right? It's up to you if you want to get them shares of your business. Again, if it's a volunteer or an advisor, you do have to deal with the valuation issue because they're not employees, and if they're not going to sign on as employees, there will be taxation depending on the value of what you're providing them. So if you're going to give them 2% of your business, for example, which is a very high number, right? When you're dealing with an advisor, 1 to 2% is a very generous figure. But if that's the number you're going with, you'd figure out what is the value of that issue. Now, the taxation is the onus here is on the individual or the volunteer, the advisor, not on the company. But there is a taxation issue.
Okay, and the next question is method to determine FMV.
So there's no real formal method. Like, so we are not CBVs. We're not certified business evaluators. And I'm not suggesting you need a business valuation at these early stage processes. It's more of looking at what is your growth, maybe factoring in your MRR in your specific, your monthly recurring revenue, sorry, when you're in your specific industry. There's a lot of different factors to put through. And again, the idea of what would you sell your company for and what is worth are two different discussions. Amongst the group, I would argue you want to keep that value lower. The lower the value, the more benefit to the employees, but just having some methodology in place, maybe a couple other methodologies and coming up with what is the average across the best. But there's no formal CBV required at these early stages. As your company progresses, and once you go out for a series raise, all of a sudden you do have some methodology because you have come up with a figure and you have the benefit of people buying in at a certain dollar amount. Now they are buying in on a future growth expectation, but at least there's some methodology in place. So there's nothing, it's not a science at this point, but you do need to have that methodology and consistent revaluation of your model to show that you've been doing your due diligence on the management side.
Okay, and the next question is, can reverse vesting be based on milestones instead of time, like milestone in a startup?
Yes, it definitely can. Again, it's all subject to whatever the group decides. It could be a combination of both, right? It's really, I've seen more for the key employees getting hired with getting shares. It's more milestone based for that reverse vesting schedule than the founders. Usually the original founders, it's gonna be based on time if everyone's efforts equal, but short answer, yes, you have full flexibility.
Okay, and the next question is, I understand that when the option is executed, there's no monetary transaction with the employee, question mark?
That depends on what you've done from an exercise pricing point of view. What I've talked about mostly today has been issuing shares for no value, for no dollars, while falling into the stock option rules. But as your company progresses, if you're going to have a dollar value on the option, so let's say the employee has the ability to exercise their options at a price of $1.46 per share or any number, there will be a monetary transaction at that point. So it really depends on how you set the plan up and how what you want the employees to buy in at. You can issue shares for nothing, or you can issue options to allow them to buy at a certain dollar amount.
Okay, and the next question is, how do I set up a fund for adult children working for and not working for the corporation?
By fund, I'm going to assume the question is how do you can have a trust hold the shares on behalf of a minor so that when they become of age, they get ownership. But with the new rules and even remunerating family members who are not active in the business is not advised. There's some pretty negative consequences of paying people who are related people who are not working in the business.
Okay, and when is the right time to do a Series A offering?
I mean, there's no formal time period. It's your typical structure is you will get people to inject cash or cash by way of safes or convertible debt at some point before you get to the Series A. But it's really, once you formally close your seed round, you're normally looking, you'll have a runway of 6 to 12 months at that point.
Okay, the next question is suggestions for how to split company ownership for startup, say for 3 people. When will it be even, and when be uneven split? Factors to consider in this.
I mean, there's no hard fast rule for this, but I would consider what is everyone's contributions going to be. The idea of the implementation, is the idea person the technical person as well, or is this possibly the idea person's not the technical and needs to rely on the other founders to build a model? But and then looking at what are your contributions going to be going forward. Again, that concept of full-time versus part-time. There's many things to consider. I would just say, just if being comfortable as a group, and you need to decide that, but ultimately the idea is usually going to be one individual's idea, but then the concept of how that's going to be brought to life will dictate your ownership. But again, there's no hard rule for that one.
Okay, the next question is, if we hire employees based in the US, I assume we can still apply the same stock rules and taxation to them, just like Canadian employees, question mark?
The answer is no. When you're dealing with non-residents, so they'll be taxed in the US rule. So I don't know what the US taxation of getting options in a company would be. So one of my partners does deal with US personal taxes, and he may have the answer, but that's a pretty specialized question. If you're going to have employees outside of Canada, though, there are a whole bunch of other just tax issues and employment issues to be considered.
Okay, and we can add other shares. The question is, can we add other share types later? Will there be a cost to add later? And if so, approximately how much?
You can always amend your articles of incorporation at some point. I can't speak for lawyers, but amending your articles to include another class of shares, we'll say $300 to $500. Again, you obviously can't quote me, but it's not a significant cost at that point. In the startup world, I mean, normally your ownership structure is going to be very lean. It's not like your typical family business. Generally, there's one class, maybe 2 classes of shares. So I've seen stock options being issued with we'll say a class B common. Other times, the stock option plans are still part of the same class as the founders have. But again, the details are falling back on the agreements outside of the articles. The reason being, the investors looking into your company, you don't want to have to spend 3 minutes explaining your corporate structure to them. They want it clean and simple. And so they're willing to invest in. So in this tech world, it's generally 1, maybe 2 classes. Yes, you can amend your articles later to include a separate class of shares.
Okay, and what would you recommend when 2 companies want to create a joint venture? What would be important for both parties to feel at ease?
There's a few different ways you can look at it. We're dealing right now with a larger company, a smaller company sort of coming together. What they've done, from their example, they've come up with their agreed upon values of the IP and the contracts that they have in place. And the ownership there, what we're going to be recommending is it's going to be an amalgamation of the 2 companies. So bringing them fully as if they're one company, and then the ownership will be issued based on that agreed value. There's different ways. If you could look at transferring or either acquiring the IP and again issuing shares. There's taxation. You could do a Section 85 where you could roll the IP into one other company taking back shares. So there's a few other options. If it's simply just going to be creating a new company going forward, so a new joint venture moving forward, I mean, again, it's just agreeing on how is that ownership split going to work and relying heavily on your shareholders agreement.
Okay, and when dividing up shares at a startup, is there a recommended amount or percent of shares you should hold back in the company as unissued?
Typically speaking is when your articles, you issue originally a large number of shares. but the authorized capital is there's an unlimited amount. However, there needs to be specific approval at the board of directors to issue more shares. On the stock option world, once you implement your plan, normally it's 5, 10, 15%. Is, again, you can definitely go higher, but those are the general sort of where you fall around 10% of the, you create a pool. You don't need to issue all 10% of that. You can hold back. That's a set number. But when you're initially dividing up the company, you don't normally, you can, but you don't normally put a cap on the amount of capital to be issued. It's you issue based on whatever your relative percentages are going to be. You have the ability to issue more shares, but again, subject to the approval of the board of directors.
Okay, and can you apply and get a corporation number before knowing your stock options?
I'm going to interpret that. So when you incorporate your business, yes, you can get a corporate business number without having a stock option plan. You know, stock options aren't a requirement, right? This is something that anyone can add in and down the road. Again, even like coming back to that family bakery can have a stock option plan. You'd have to really wonder what is the purpose for it, but it's possible to implement it. So yes, you can have a corporate business number with CRA without having a stock option plan.
Okay, and the last question is there an alternative to give advisors such that you don't have to value your business?
If you want to get them ownership in the business, unfortunately, no. Otherwise, I mean, you could have them buy in, but that's not it's not that it's not advisable, it's not usual. I would say that the earlier you do that process, right, the lower the implication, right, because the lower the value of your business. But effectively what you're doing is instead of paying them cash, you're paying them in shares. So if you think of it that way, there's really no way of getting around it. I mean, I guess in theory, if everyone agrees that the number is exceptionally low, then there's really no issue. But generally speaking, if you're going to be paying someone cash or shares, there's going to be taxation, notwithstanding employees and the beneficial rules for stock options.
Perfect, and that's all the questions for today that I could see.
All right. Well, thank you everyone for sticking around. It's been fun. You have my coordinates, so if you have any questions, please feel free to reach out and we can gladly set up a one-on-one conversation. Have a great day, everyone.